Well, good morning, ladies and gentlemen. We've got a crazy week that we've had. It was election week, and everybody voted this week. And I took delivery of my Tesla Cyber Beast, and we've actually got a special guest here, a gentleman by the name of Dale Brosey. He came down to the office this morning, drove all the way from across the pond, across the
I
pond.
literally crossed a pond.
He crossed a pond. Did you take? That's right. You said 61.
Yeah,
You took 61 north
yeah.
to come north to here, so you got to see our split lakes, our divide that we got right at the entrance of Old Town White Bear Lake, and that was how was that for you this morning?
It's pretty good. You know what? No way to predict. I had no idea what traffic like was be like in this part of the metro, so it was great. Good drive. No snow. Yeah,
Love that. No snow even.
no
Holy cow!
snow.
My goodness. Check that out. And just a little bit of footage, from the Trump commencement speech. I don't know where you actually sit at politically, and I don't personally want to get into it, but if you want to, we can chat about it really quick. I just wanted to throw that up there so that everybody knew that President Donald J. Trump is president again, and Kamala Harris had a long concession speech. I don't know what the rest of yous feel about that. What do you think about that one? How'd that go for you?
Who, me?
Yeah, who you?
You know what?
You, Dale.
Yeah, you know what? I've been kind of in the independent camp since Perot.
Oh, okay.
So
Ross Perot.
and
Oh man.
yeah, I was a Reagan Republican back in '84 in the '80s when I was active duty.
Okay. So
And
you're a veteran.
I am veteran.
Thanks
Yeah.
for your service,
Oh,
man.
thank you,
That's
thank you. It paid for college.
that's bold of you. Well, and that's what I think a lot of people did that. And the thing is that you got more education out of going active duty than you did in college in some cases.
I would
For
certainly agree. I
for
would
a lot of
certainly
folks,
agree.
you
Yeah,
get kicked in the nuts that many times and slapped in the face. Oh my
yeah.
gosh.
But politically, and we can get into it because I appreciate your podcast and the content you put out. And any discussion would probably need to be in the context of what do we do as investors going forward,
Yeah,
because
absolutely.
it's settled
I
right at
agree.
this point, right? So we know we got 4 years of a new administration. How do we position ourselves as investors? And that's really all we can do. People can rant and rave about it. It is what it is. Let's plan.
I think a good actually would be a really good segue. Dale Brosey, and ladies and gentlemen, local celebrity Dale Brosey's comes all the way from the far off distance of the Eden Prairie. Now, is that next to China? That's like really far away. I think you
I
drove like an hour to get
Yeah,
here.
I
I
can
think it
see.
was like an hour.
Yeah, I can see China from my place.
That is
Yeah,
insane. How's the view over there,
it's pretty
man?
good.
That is
Pretty good.
great.
Pretty good.
Tell us a little bit about, and again, as all of you know, I'm your Get It Done Dad on all platforms, and Living in Twin City Suburbs is the YouTube channel. Please go there today. We got a new video dropping this evening at 8 p.m. for all of you subs out there, and we absolutely love you guys, and we thank you. I know I took a hell of a hiatus from actually uploading new content. We've got about 10 videos that we're going to be loading up here over the course of the next 8 weeks, and to keep things rocking and rolling. So we love you guys. Again, I'm sorry for not really checking in there for a while, but one of the major things that we like doing here at the Hilton Family Professionals, the White Bear Lake Studios, ladies and gents, is we love talking to local investors as well as local realtors and real estate professionals. Why? Because I'm obsessed, I'm obnoxious, I have no friends other than friends in the industry, and that's pretty much all we talk about. We sit around and talk about shop because we don't have real jobs. And however, we may work 7 days a week and potentially work 100 hours a week on a regular basis, but that doesn't change the fact that if I don't want to go in, I don't have to. I choose to, and that's why it's awesome to be working with a licensed professional, as well as to be working with seasoned professionals that are insured and bonded and all that kind of fun stuff and everything like that. And so that's who we try to bring you because we love you guys and we want to give you good referrals so that we're not talking out of our rear end. Would you agree with that one, Dale?
You know what? Being in the delinquent debt side of real estate, I couldn't agree with it more.
Yeah. Tell me why you couldn't agree with it more, sir.
Well, there's compliance issues, right? And I do talk a lot of them. If there are investors that are selling on seller financing and they're not aware of some of the compliance issues, they can get themselves in trouble. Or
Yeah,
it can
like with
just,
RESPA and stuff, right?
yeah, with RESPA, debt collector's license and so on and so forth. So, I'm very vocal in, know the compliance issues of whatever you're doing in real estate. And if nothing else, not necessarily just, even if it's not a matter of staying compliant, it's just going to make things easier for you over the long term. So, working with a licensed loan servicer or whatever you're going to do, they're just going to make your life easier as a professional.
Yeah, and like so you do delinquent debt stuff. So tell me a little bit more about that if you don't mind.
Yeah. So as you know, I'm a note buyer. I'm a note investor. Got exposed to note investing back in the 1990s. I did have some rental properties 30 some odd years ago here in the Twin Cities. I learned very quickly that being a landlord was just not my bag.
Just wasn't for you.
It was not my bag. This was downtown Minneapolis. It was a fourplex or a 4 unit building. And it was screening for tenants and hoping to find the right tenant, and then dealing with issues on weekends and so on and so forth. I was self managing, and
I'm in that camp.
yeah, I was self
I
managing.
got that mirror badge.
And I was living in Egan at the point, so that's a southern metro. So it was I just realized there had to be a better way. At that time, I was also investing in various income or cash flows. I was doing what's called factoring invoices, which is simply buying a future stream of payments from somebody else at a discounted rate. This was back in the 1990s. I was at a conference in San Francisco at a debt investors conference, and I met some people that were doing mortgage notes, and I said, explain to me what investing in mortgage notes means. They described it. Basically, we are the bank, I am the bank on real estate, and I'm simply collecting monthly P&I payments, and I have an owner occupant, not a tenant. And I said, I like that a whole lot more. Um,
Seems like they would have a lot more pride of ownership,
yeah,
or like taking out more accountability for the property as opposed to somebody who's just renting.
absolutely, absolutely. It's a completely different dynamic, and I'll always take anytime I present. I got a presentation to a group coming up in not next week, but the week after. Introduction to note investing, and I always position it that I appreciate everybody's role in real estate. Everything, we need wholesalers, we need buy and hold people that own rentals, because we're always going to need rentals. We need fix and flippers. We need everybody within the community. We all play different roles, but yeah, it's I just found my niche, and now
You want to give me details on the introduction to note investing? Is that okay? Is that a
if
thing, or is it a closed meeting?
no, it's not a closed meeting. It's a local group. They used to call themselves the Millennial Investors. I don't know what they call themselves now. I know they just did kind of a regime change, and
A regime change.
I know they just we meet in North Minneapolis. I will certainly send it to you. I asked the organizer to send me a link to the event as soon as she has it.
Do you have a phone number that they could call?
Oh gosh, I do not.
Oh well, that's not very helpful.
Yeah, all I can say is I know it's November 19th. That's all I know at this point.
You're killing me, Dale.
I'm sorry, I didn't mean to kill you this morning.
If you guys are interested in it, make sure you drop a comment below, and just inquire, and we'll get you all the major details. It's December 19th.
Oh,
Or
November
I'm sorry,
19th.
November. The intro is November. We got to get something. We got to get a new media guy in here because this guy sucks. He doesn't know how to type. Okay. Meanwhile, back at the ranch, you were saying, sir.
Yeah. So historically, I've been buying performing notes. I'm more active in Arkansas, Oklahoma, Tennessee. Nothing in Minnesota. Arkansas, Oklahoma, Tennessee, and actually some in New York State, north of Albany, which I consider that like central New York. Um,
Wow,
but
that's interesting.
yeah. But I've definitely seen over the last 3 months an increase in activity amongst lenders that are sending out. It's essentially an Excel spreadsheet of non-performing loans, that they send out to investors.
So you mean like people that aren't making their payments?
Yeah, so people that are delinquent or they've already initiated foreclosure on the property and the bank is selling the property prior to completing the foreclosure, simply because they just want to move it off their books at
They
this
just want to
point.
dump the paper.
Yeah, they want the paper off their books at this point. It's more of a logistical movement that they start the foreclosure. So I'm seeing loans that are anywhere from the notice has just been served to there's a foreclosure date set. So I see it across the board. But I mean, the advantage there is I'm still buying only first position. I don't buy second position. We can talk about some of the private lending stuff that I do as a second position lender, as a different subject. But I'm only buying first position. But I'm just seeing a lot more inventory. They're sending them out a lot more. They're getting more aggressive in selling these loans off their books. So I've kind of pivoted within the last couple of months to focusing more on the non-performing.
I love a good pivot.
Yeah, I did a video about it, and I put it on one of my whiteboard videos, and I said I'm seeing a generational opportunity, not only in single family, but I'm seeing it in multifamily, and if somebody wants to get into commercial as well, those are opportunities that are certainly presenting themselves right now.
Wow, what do you mean by commercial?
Well, there's like $560 billion worth of commercial. So I'm going to break it down, talking just multifamily. This isn't office. This is multifamily debt only, but $560 billion that needs to be dealt with between now, fourth quarter 2024 and the end of 2026. Things coming up on maturity because, as I'm sure many of your listeners know, commercial is short-term funding. You don't see 30-year notes. You don't see.
Yeah, it's only 20 years.
Yep.
Normally at the max.
Yep. So, and a lot of the stuff was 5-year adjustable or very short-term.
Yuck.
So, this stuff is coming up on maturity. So it's a big debt wall. Matter of fact, I do have some numbers on my little tablet here that I can go over.
Ooh, share them with us.
Yeah, I can pull that up. So I had done a video.
Do you wanna share it with everybody?
Yeah, sure.
Okay.
Well, everything I pull is right off the bank FDIC filings. So this is public information. This isn't secret information from a secret source. It's FDIC. All the banks, every quarter, they fill out their FDIC filings.
Yep.
They open the kimono and they said, here's what our loan portfolios look like.
Did you say open the kimono?
They opened the kimono.
That was potentially inappropriate reference, but I really appreciated it.
I don't want to get you flagged or anything, but
well, you got my head just reeling right now.
Well, it's what I'm here for.
Well, that's all I can think of is a geisha now. Gosh, I really want some sushi.
It's sushi at
Moving on.
in the morning. Is there breakfast sushi? I've never heard of breakfast sushi.
Oh, of course there's breakfast sushi. There's sushi 99% of the time. My gosh. Oh my goodness. They eat when you go to Vietnam. Well, I mean it's the same thing over in China and Japan. Japan is. I mean you can get sheep head and goat head at 8 in the morning. They just bring out this huge skull that they boiled for 10 hours or whatever it is, and oh my gosh, it's delicious. Well, and you eat it outside on the sidewalk in a tiny plastic chair.
They don't eat sugar-coated things for breakfast in the rest of the world. I guess you could get frosted sushi, I suppose.
Oh, gosh.
So what do we got here? So I did a video last week talking about this delinquent debt wall in multifamily.
Okay.
And the numbers are within context. So I'm just going to share these as numbers, and they're for the sake of discussion, these are just numbers. Across the United States, for the lenders, the amount of non-accrual, so non-performing debt, non-accrual debt, and it's defined as non-accrual in the FDIC filings. In the second quarter, there was $2.98 billion worth of multifamily debt that was non-accrual.
Okay.
And so the third quarter numbers finally came out this week, updated third quarter, and that's gone from $2.98 billion to $4.38 billion.
It's literally doubled, you guys, in the last 3 months.
Yeah, so this is non-accrual. This is... When you look at a loan portfolio, you got 30 plus up to 89 days, and then they start dropping the loans into non-accrual. They said it's no longer slow performing or scratch or dent loans or delinquent.
Yeah, we know
debt.
It's just bad news bears.
It is now non-accrual. Now non-accrual is the last step before it goes REO.
Yeah. And what is REO? What is your impression or the long form version of REO?
Well, REO, the lender has simply completed the foreclosure and they've taken the property back. And so REO, or bank owned property. So now the bank is sitting on this property, which as we know, banks are not in the business of holding real estate.
Known
So,
as real estate owned, but
yeah,
known in the industry as REO
REO,
properties.
REO, yep. So, but
Like
now,
REO Speedwagon, but without
exactly,
all the instruments.
that's right. Yeah, without all the instruments. And as you look at it through the lens of a lender, um, it's a liability now, right? They've got to maintain the property. They got to cut the grass. They got to stay. If you're like in the Twin Cities or if you're in a larger metropolitan area, now that becomes a burden for the lender.
Well, yeah, because you got the city breathing down your neck if if the grass ain't being mowed, and
Yeah, all the
shit's getting
ordinances.
cracked and snapped and smashed.
Yep, and you got to pay to secure the property. You got to lock it up. You got to make sure it's being monitored so you don't have people breaking in, taking copper, and so on and so forth.
Oh
So
yeah.
it becomes a liability. So, and then that's one reason I talk to a lot of investors saying, well, if things are so bad, why aren't we seeing the REOs that we would expect to see? Well, that's because the lenders have been playing this game of extend and pretend. Last week, was it last week or the week before, the Fed came out on a Friday with an announcement basically chastising lenders for playing this game of extend and pretend. So, what is extend and pretend? They've been extending these loans, hoping that at some point something would change. Change in the rates.
Like somebody's gonna start talking or start paying their payment or what?
Well, I think they've kind of written off the idea that these lenders, the borrowers, are able to make the payment because NOI simply doesn't work anymore.
What's NOI, if you don't
uh,
mind me asking?
so yeah,
That's important.
in the multifamily space, you kind of it's one of the numbers that you look at. Net operating income. So what is my net operating income of this? I don't care if it's a fourplex or even a larger unit, but what's my net operating income? And as we all know, that insurance rates have gone up, or costs of holding real estate have gone up. Whether it's
Oh my God, insurance rates have been absolutely stupid this year. I even opted. Can I share something really quick?
please,
I opted to, and this is terrible, but on one of my properties because it was, for whatever reason, they were literally going to triple my insurance, and because of a claim from like 3 years ago and or 4 years ago, and they just let me know what it was going to be, and I dropped the insurance because I was going to go with another insurance company, and I just never wound up doing it.
mm-hmm,
Having a mortgage on it, that's quite dangerous, and
yeah,
it's not a really good plan, given that your house could start on fire at any time. It could get hit by hail. I mean, somebody could run into it with a car. I mean, there's just a multitude. Now, granted, I've been an investor, been flipping properties for the better part of 26 years. So I'm no spring chicken as it relates to fixing properties up and finding ways of fixing properties and doing it for, some people would spend, 40 between 40 and 50, and I'll spend 10.
yeah.
So just mostly just because from my expertise, but I I got contacted by the mortgage company, and they're like, "Listen, asshole, you need to put insurance on this right now, or we're going to insure it." And I was like, "Oh crap!" And all I could think of was that they were going to just put this terrible, awful insurance on it, and then they're like, "Yeah," and the premium is $982 for the year, and it was like, "Okay,
Yeah,
done.
yeah.
You guys get to cover it now and just roll it into my payment. It's fine for the next couple of years," because I couldn't believe just how bad it was. And as long as we keep it insured, there's a history that you have to keep with insurance. For those of you that don't know, if you take insurance off of your property or other properties, for example, and you're not even part of an insurance company, you're an even bigger risk,
Mm-hmm.
and they will charge you even more for your insurance. So it's like, at worst case, and this is the thing I always tell people, is like, if bills are really tight and stuff, and you're going to be one of those crazy people that takes your life and other people's lives in your own hands, make damn sure you at least put liability on your vehicles, because it's going to be even worse for you if you drop the insurance on your car. And it kind of works the same for homeowners,
Mm-hmm.
because if you got mortgages, dude, they can see that stuff. You're not fooling anybody. Now, I mean, I understand, if it's the difference between, clothes on your kids' backs and, paying the insurance. I could see where, you might make an educated or a strategic decision on the basis of that. I can see how that could be a thing. However, I strongly encourage you against doing that because it is a very dangerous position to be in. And I remember that for like I think it was like 3 months. It was back and forth and whatever, and I forgot about it for like a month and a half. But it kept popping up, and I realized it was something that was actually weighing on my mind, because it was over the course. I think it was over the course of the tail end of the summer, and we had some tornadoes and some pretty rough weather. I think it was like 22 or something like that. And looking back on it now, was it 22? No, that's not true. It was 23. Anyway, and I learned my lesson, and I just went with it like that, and it was like, oh my gosh. And the unfortunate part is, remember, guys, as it relates to insurance for you homeowners out there, and for my past clients, is if the bank is going to insure it, they're not going to insure it for a lot.
No.
Even though it would behoove them to insure it for a lot, because then that way, if if Annie M comes to visit, or the Wicked Witch of the West, and they huff and puff and blow your house down with a tornado, they would get a hell of a payout on that one, and for sure be made whole. But I digress. It's whatever. Keep insurance on your homes.
Yeah.
And for those of you that got any questions and you've got issues with payments or things of that nature, you can always feel free to reach out to me directly on the Facebooks and off the interwebs, HiltonHomeTeam@gmail.com, or 763-221-4009. Shoot me a text, shoot me a call. There is no story that probably I haven't heard already. And meanwhile, back to Dale Brosey. Sorry for that really hard left we took, Dale.
No, that's cool. I can address another issue when it comes to insurance. Number one, I would say it's a contractual thing, right? If you're a homeowner and you sign a loan, you sign an agreement, it is a contractual thing. You're in violation of your contract if you do not maintain insurance. On the debt investor's side, matter of fact, I just had an investor call me about that this week. They were talking to their attorney, and they were holding the mortgage with an owner occupant, and it was that situation where they knew that the owner was not carrying insurance. What do I do? The attorney says, well, you need this thing called forced place insurance. Well, the attorney didn't know much about it, and the investor didn't know much about it, so they called the note guy. So they called me, and I gave them the 911 on forced placed insurance. Now, what we'll do is we'll actually buy forced place insurance in bulk, where we just have a portfolio of properties and we just buy a policy, and there can be multiple properties in this forced place insurance.
That's what makes it. So sorry about that. Sound guy, got to fire him. That's what makes it so expensive or so cheap, is because you're buying a huge blanket policy. Is that accurate?
Yeah, and it's not specific to the property, and you might just get things like catastrophic and what have you in there. But
that's essentially what they told me.
Yeah, but essentially our collateral is protected. But you definitely are. I'm definitely hearing of people, if they're people that are, and this is an older population from what I understand, that down in Florida, that are free and clear, and they can't afford the insurance, and they are electing to drop the insurance.
Yeah, because the insurance is damn expensive.
Well, when you live with hurricanes,
you're the one living next to an ocean.
Yeah. So.
Oh, that was so rude. I'm gonna get slapped for that one. Lord, I apologize for that there, and be with the starving pygmies and no getting.
Yeah. I can get an inappropriate real quick, but when I was looking at non-performing debt down in Florida recently, I stopped calling borrowers underwater, and I just said they were upside down their loans, because I guess I shouldn't be calling people delinquent debt or delinquent
too
loan.
Soon.
Yeah.
That was worth it. Thank you for that.
You're welcome.
Thank you, Neil Rosie. That was, oh man, that's rough right there. So it seems to be that you're underwater, sir. Literally, you jerk. That's not nice.
Ba-dum-bum.
Try the veal. We'll be here all week, ladies and germs. Oh my gosh.
Yeah.
That's crazy. So,
but I would say, if you have investors that are listening, at least be familiar with what forced place insurance is and the fact that it exists.
Yeah, absolutely.
Yeah.
So what have we covered so far? Donald Trump had a commencement speech,
Yeah.
and Kamala Harris had a is it a concession? A concession?
Yeah.
She
I
had
guess you would say that.
nachos.
Yeah.
She had the nachos.
Hmm.
Gosh, I love nacho cheese. I don't get what it is
Is it
about those.
cheese?
About those. No, it's not. It's cheese food. That's
Yeah,
not
that's
a
right.
thing. But I actually know an efficiency specialist that actually one of his clients was Velveeta, and he made like a $15,000 or $20,000 commission on the basis of explaining and putting one panel of stainless steel more to stop them from the cheese food falling off of a conveyor belt into a wheelbarrow that was sanitized, of course, but it
Hmm.
was a sanitized wheelbarrow nonetheless. Holy goodness gracious. It's a freaking wheelbarrow of cheese. Dude, what would, I mean, how would that be? That would be awesome. Anyways, I just love that cheese that goes on those nachos, especially like when you can smell the popcorn and whatever, and like the sweaty feet, like in a gym. There is something that is just absolutely, it's just a symphony in my mouth, and I love it. It's
But
absolutely amazing.
hasn't queso dethroned nacho cheese food?
Well, not really, because you put it in the can, you heat it, or you take it out of the can, you heat that shit up, man. You can charge $5 for a thing of drooly, drippy, disgusting cheese food nachos, and man, have they got a flavor. Well, that and you can put that on a hot dog at Holiday gas station. I mean,
If you,
really?
if you're a risk taker, I suppose you can have the sushi while you're at the.
Yeah, and have the cinnamon sugar dusted salmon sushi,
There you go.
that raw salmon.
Yeah.
A little bit of raw salmon at a gas station. It never hurt anybody. It's only a few days old. It's
Can
fine.
only make you stronger.
It's fine. It makes you tough.
Hmm.
You need to try that stuff, you guys. I think I actually did that once. Ooh, and it was a bad situation. It wasn't even real wasabi that was in the little carton thing, whatever. And I just remember we got like two pieces and it was like, all right, I'm gonna muscle through this because it cost us $4.39 and we're already 20 minutes north on 35W.
You gotta watch. How many miles to the next rest stop?
I think there's a quick trip up here.
There you go.
Maybe we can get some honey buns or some glazed donuts right after raw salmon sushi.
Mm,
My goodness, man,
Making my
life
mouth
changing.
water.
I love it.
So
Well,
you want me to? So I'll keep going with
you
these.
go
'Cause
with your
I'm
stats.
sure
Yep.
people aren't interested in our food
No, they're
preferences.
not.
So I
They
talked
don't
about
care.
the multifamily, and are you primarily broadcasting to Minnesota? I don't know what your audience is. I apologize. So
Yeah, we're here, and
are you global?
well,
Are
right
you
now.
international?
Well, not go. I mean, sure. There's a few likes from across the pond.
Okay. So
However, we are broadcasting mainly to Minnesota because we got a little over like 10,000 people that we
cool.
that we can batch out to
All
that
right.
actually see this.
So I'll,
So,
I'll I'll throw out some Minnesota numbers then for you.
ooh, I love it.
Yeah. Because
Definitely do some Minnesota numbers. Yeah,
yeah.
absolutely.
Because
This is right here on boots on the ground,
yeah.
guys.
Because as a note investor or note buyer here in the fine Twin Cities market, I definitely every quarter I look at all the Minnesota banks. Those are the banks that I monitor the most, and
How come?
um, because I'm I am focused. Oh, I'm looking right there. I'm focused on trying to build a relationship with local banks so when they do sell non-performing assets, I'm going to be their go-to guy on that. I'm not seeing much in Minnesota. I'm not getting much. I'm mainly seeing loans in Texas, New York, California. Well, I did see a lot in California recently. New York, Florida, and Texas. I see them in all the states, but those are the main states that I'm seeing non-performing loans that are currently being sold by lenders. I'm just not seeing much inventory in Minnesota, and I'm trying to reach out to the banks, local lenders more to let them know there's a resource if they want to sell those
Is it potential that
non-performing houses.
they're just holding stuff close to the chest, or
You know,
and like hiding their cards under the table?
yeah, so depends on the size of the banks, and as you know, we have several hundred banks that are based here in Minnesota, and we got everything from the large players, right, from the Wells Fargo's and the Bank of
Wells
America's,
Fargo.
Ameriprise, and all the big players. And then we have the large regionals, and then we have the smaller community banks. And when I have conversations with the smaller community banks, they've never, many of them have never been through this. They haven't seen this stuff, right? We haven't been in a I don't want to call it dangerously delinquent, but a rising delinquent environment since the great financial crisis. And some of these people have just never been in that situation, right? We've been in artificially low interest rates for 15 years.
Oh yeah, it's been a while.
And so it's just a dynamic they're not used to, so they're not accustomed to, nor do they have a process. We don't know how to sell these non-performing assets. But so anyway, that's my mission.
Which is crazy because old dogs that have been around forever, they're like, "What the hell? You guys don't know? You do realize 2008 happened, right? That
Right.
wasn't like a
Well,
fairy tale in a book that somebody wrote. That was a thing."
well, when I'm talking to some of these people that are in their 20s, it's
Well, of course,
you know,
never seen that shit. It's a whole new generation of financial analysts and stuff that are
yeah,
they're like, "Boo,
yeah,
what's this?" It's
yeah,
like debt
yeah.
that's non-performing, and it sucks, and it's
Well,
gross and ugly, and you know what? It's just it's a part of life
yeah. We just
for a lot of
recently,
people.
I would say this last quarter, we did have a Minnesota bank that was shut down by the feds for, um, uh, you know, bad banking behavior. So that definitely happened. So
So give us a real world example. What's bad banking behavior?
well, when they let the non-performing loan ratio get above a certain threshold, that's when it triggers triggers red flags. At the Treasury and at the federal level, and they send out bank inspectors to visit that bank and say what's going on. Once your non-performing loan ratio gets above the benchmark is 6%. If any particular loan portfolio gets above 6% non-performing, that supposedly sends off red flags. Bank inspectors start calling the bank, and the banks will say, "All right, we're going to come visit you. We're going to take one of your cubicles, and we're going to sit there and we're going to micromanage you until you get your loans in better shape."
Set up setting up systems where like True Stone Financial, for example.
Yeah.
I've got a travel trailer note, and we have tirelessly tried to set it up on an auto payment, and they pretty much call me every single month, and they're like, "Hey, we're not going to charge you a late fee. We just need to get the payment paid. You're about 3 days late. Wanted to touch base with you, check in, make sure everything's okay. Are you going to need any assistance? Da da da." And this absolutely marvelous young lady calls me
Mm-hmm.
like every month.
Yep.
And it's like, "I'm sorry, that wasn't intentional. Here's, whatever. Can we do a one-time payment today?" "Yeah,
Yeah.
absolutely. Go right ahead. It's fine. It's connected with the account. It's okay. Just do it."
Now that's a credit union, right?
Yeah, it's a credit union.
And
Yep.
they operate differently than banks. So I'm
They
definitely
do, but I mean, do I make any sense? I mean, is that what like you're talking about, like when they're micromanaging and stuff? It's like you need to get a loss prevention program in place. I see that you only have 3 loss prevention people. We need to get your middle management to hire 7 more people because it shows about on the basis of statistics. Da da da. If you had this many people that were experienced within the next 6 months, that we could drop that from 6.357 down to 5.216
Yep.
or something
Yep.
like that.
Well, some of these people have no loss mitigation people.
That is so great.
You
That is
know,
mind blowing, dude. I thought that became a thing after 2008. Like you couldn't even be
no,
a bank
no,
if you didn't have that.
no. They might have risk people. They might have risk analysts, but they don't have loss mitigation
Oh
people.
my
And
gosh.
so when I am talking to them or I'm reaching out to them, that's who I'm trying to find. I'm trying to find loss mitigation, or what they call the special assets person, and they simply don't have those people because they've never been prepared for. So what do we got in Minnesota? So second quarter. This is we're sticking with the multifamily because that's what we talked about before.
Yep.
So in Minnesota, we have $20.5 million. In the second quarter, we had $20.5 million of non-accrual multifamily debt in Minnesota. That's second quarter. In third quarter, we went to $24.7 million. in non-accrual multifamily.
So that's approximately 20% increase.
Yeah, we went from 20 to 24. Yeah,
And you guys, this is not like it was at 20% and then a few more houses popped up, so now it's at 24. It's like,
yeah,
no, that was new shit that was $20 million or 20 billion or whatever, $20 million, and then another $24 million.
hmm
So it increased by 20%. Now, it would be interesting to note as it relates to non-performing commercial debt.
hmm
Now, is that normal for the fall time because we're getting out of summer? The people aren't rolling in the bank anymore. They're not making a bunch of money because, whatever, because it tends to be cyclical
yeah.
like that. I mean, because a lot of people that you've got your seasonal workers and folks like that they've got tons of overtime during the summer, and then their life sucks during the winter and they're broke all winter long until March 5th, March Madness rolls around again. Then it's like, hey, wow, oh my gosh, I have a job, we gotta make hay while the sun shines.
Yeah.
Is it like that kind of, or is that not a thing?
Well, since COVID, there's no normal anymore. And we also saw a building boom, during COVID. And so if we're just sticking with the multifamily space, in multifamily, just about every major metro saw, an incredible building boom, right? And so a lot of new Class A space coming on board and what have you. Now, if you want to talk seasonality when it comes to lenders, is that yes, going into fourth quarter, you do tend to see them selling off assets more, taking what's called charge-offs. They might have non-performing debt on their books, and they start writing it off. So they take a charge off prior to selling off the
Once it
asset.
gets to like the 120-day mark, agreed.
Yeah, well, some of the stuff is a couple of years behind. Something
Totally
like that.
understand that
Yeah,
part, but what I'm
yeah.
saying is like it reaches charge off level at like 120 days.
Correct. That's when they can begin their process and what have you. Now, of course, when we're talking about multifamily, we're talking about commercial lending versus owner occupied traditional type of lending. So there are different rules that come into play. But yeah, going into the fourth quarter, that's kind of when you see them moving some stuff off their books and getting prepared for the next year. But as far as seasonality, there's been so many developments that it's really kind of thrown off any kind of seasonal expectations that we would have seen prior to COVID.
Well, that and we didn't
Um,
have any freaking snow last year, so people
and
just
that
kept
too.
just grinding right on
Yep.
through.
Yep.
For those of you that are wondering, hold on just one second here. For those of you that are wondering, for our viewers out there that are not maybe up to speed on this one, just because we're talking about commercial debt doesn't. We're talking about basic, like the companies that are paying their monthly, let's call it, for those of you that have no frame of reference as it relates to business, right? We're talking non-performing debt, or somebody borrowed money. If you bought a house, you borrowed money and you have to make a payment every single month, and that payment is due at a certain point. So when we're throwing around numbers like 90, 120, and the blah, 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 and the things and the squirrels, like that's just simply somebody making a payment every month.
hmm
And they may be 30 days late, 60 days late, 90 days late, or 120 days late. And what he's speaking, or Dale, what you're speaking to, and stop me if I'm wrong, is you're speaking to when they charge it off. The actual process of charging it off is pretty much just like control alt cop, or cut and put over in a different category, and simply that's what they're just calling it that because they're trying to sideline that stuff and put it in a different bucket and say,
Yep.
okay, so somebody else has got to deal with this within our company internally, and we need to focus on the money that's coming in to pay off the debt that we already borrowed out that's already been spent.
Yeah. Yep. Yep. It's putting it in a different bucket, and it's saying that we know we're not going to get this loan performing again, so it's gone from non-accrual, and we're just going to write it off.
Yep. Okay. Get that.
Yeah.
Totally get that. Thank you for sharing about that kind of stuff. That's really cool.
Yeah.
I love that.
Oh, I love nerding out on this stuff.
And nerding out's the best. And I would say probably one of the major takeaways from this is that there's a lot of non-performing debt that's starting to it's increasing quite exponentially. Is that an accurate takeaway?
Yeah, I'd say anybody that's a bank watcher, knows there's a lot of unrealized losses that are sitting out there that the banks are simply and it's been a waiting game, right? The lenders have been kind of waiting for the Fed to see what was happening on interest rates, and now we went from a rate hiking or a quantitative tightening cycle into we're not really quantitative easing again, but we know we yesterday JP dropped the rates by dropped by another 25 points yesterday. And the expectations was as soon as the Fed would start cutting rates, we'd see mortgage rates and what have you coming down, and then that would open up a refinancing boom, and then we dodged that bullet, and
Kick the can down the street.
yeah, but anybody that watches the 10-year knows that since the 50 basis point cut back in October, that's not what's been happening on the 10-year yield. 10-year yield's been moving in the opposite direction. I think this morning it was 4.3, and as a result, mortgages are going in the wrong direction. So that's why I think lenders now, they watch the bond market very, very closely. And the bond market, the 10-year yield is what determines rates on loans. It's not the short end of the curve, where the Fed is active. And I think that's why they're starting to sell off some of these loans now, because they're seeing that the bond yields are going the opposite direction, what everybody in the real estate world expected them to do once the Fed started cutting rates. And now they're saying, well, that didn't work, so let's start selling out some of these assets.
Yeah, that makes sense.
Yeah.
That's a lot of there's a lot to it.
Oh.
And as it relates to those that are watching this, that just that are like, dude, I can't even compete with that. What are you talking about? Can you speak to the residential side at all?
Yeah.
Today for us? Would that be okay? Would that be okay?
Absolutely. Yeah. Matter of fact, I can hear some. You want some residential numbers?
I would
I'll give you residential numbers.
Love some residential numbers.
Okay, so I'm only looking at first position single family, and of course, single family from this perspective is going to be 1 through 4, right? 1 through 4 doors.
So let's make it simple. You have a house.
Yeah. Yep.
Okay, and like what we're talking about is people that are late on their mortgage more than 30 days. Is that accurate?
Oh, easily. Yeah.
Maybe as much as like a year.
Well, we can get into the fact that if you look at all the delinquencies across the United States and you took the average delinquency rate across all the delinquency, we're over 1,000 days.
Oh man, that's almost worse than Dodge Rams.
Yes.
Dodge Rams sale dates
So-
that are sitting in the dealerships.
I'll give you some extreme examples. I was looking at we call it a tape. When a lender sends out an Excel spreadsheet of loans that they're selling, it's called the tape. So they sent out a tape. This was in New York. I was seeing loans that haven't made a payment since 2008.
What?
2008. There was some
That
in
is
2010.
crazy.
Yeah, very delinquent.
I want a loan that I don't have to pay since 2008.
Yeah. But these things have been so locked up in, Chapter 13s and, litigation and what have you that I wouldn't buy them because there's just so much legal baggage that comes with it. But, I kind of look for things that are less than 36 months delinquent. That's kind of my buy box. But yeah, there's some things that are seriously delinquent out there. So in the United States, 16, this must be third quarter numbers. How do I do that? $16.8 billion are non-accrual, first position, single family.
Yep.
13.2 billion that are 90 plus. There's only 764 million that's sitting in REO right now nationally. For the state of Minnesota, $44.8 million in the third quarter of non-accrual, first position residential debt.
And could you give us as the rubber meets the road, what does first position mean?
The first position. So obviously, this is coming from a bank, a lender. They're always going to go in first position when they're doing a loan on a home. So this is that first lien position, or the primary lien holder. You can have seconds, you can have mechanics liens, you can have all sorts of other stuff on a piece of property, but they're always going to be in that first position. They're the primary lender.
They're the big bulk of the money you owe every month.
They're the big bulk, and they're the first one to get paid back.
Yeah.
right,
generally the one that actually forecloses
right.
if you're not making payments.
Absolutely. So,
Yeah.
and that's currently there's 91 banks that are based in Minnesota that are currently holding that 44.8 million. And so that was third quarter. In second quarter there was 41.8. So we went from 41.8 million to 44.8 million dollars from Q2 to Q3.
Again, that's a 20% increase.
Yeah. So it's out there. Yep.
That is just crazy. That
Yeah.
is absolutely nuts.
Yeah.
So would you say that is there any way to predict if we are actually headed towards a recession? I mean, and that's kind of the big dead whale in the room.
Yeah,
But
you could drive yourself crazy looking at all the data and trying, to read the tea leaves to say whether or not a recession is going to happen. Now
I
you
like
mentioned,
tea.
okay, I'm not
Sorry.
good at reading them.
Sorry.
I like tea, but I'm not good at reading the leaves. But that kind of touches back on the fact that we are now a new administration's coming in. We're not going to call it politics, but we'll call it the legislative or the environment that we're going into.
Well, and it's different, so it's going to be a different mindset. I mean, because you got people, everybody, well, not everybody, but you've got you got between like 3 and 5 major ethoses that are at hand here, or at work here,
Yeah,
and there's on the red side and the blue side, and like it just. Some people are more moderate, some people are more aggressive. It just kind of depends. And when you change administration, just as you were just referencing, there's different ways to go about things, and different people in power are going to go about things a little bit differently in
yeah,
most cases. Now, it pretty much on the general is like, hey, we it still comes down to how are goods going to get made, goods going to get shipped, and how are people going to pay for it? And there's in service goods and services, that is, that's like this. That's the oversimplified idea, but like and that's essentially what everybody's doing. Doesn't matter what administration it is, but they're going to do things differently. So when you say there's a new administration in power, it's not like a dictatorship. It's just you've got new minds or different minds that are going to be having different the same meetings, but they're going to have a different spin on it,
yeah.
so to say.
Well, what I will say here, the message I heard is that well, we need to put things in context. So since the pandemic, what we saw a lot of effort by the administrations to avoid foreclosure wall and a lot of these things happening. So what did we see? We saw forbearance, which is not a typical thing that you're going to see. So we saw forbearance programs. We saw a lot of effort in workouts to try and keep homeowners in their home.
Yep.
They wanted to avoid another 2008, another
Yep.
great financial crisis. So what we can say we did see for anybody that was watching what was happening in the lending space is that a great financial crisis level of effort was made by the government during COVID in order to keep people in their homes and avoid a foreclosure tsunami. And so now that's already happened, right? So, and now if we say, or at least I look at things as, I try to be pragmatic about things, and I don't put a political label on it. I said, okay, what do you have to tell me? Here's my policy, here's my position. So if it's true that Musk is going to come in with his Doge program, Department of Government Efficiency, and he himself even said that we got to, and it's very true. This is the inner libertarian of me speaking right now, is that regardless of what you think about politics, the United States has to deal with its debt problem. I mean, it's just become unmanageable, and the interest that we're paying on that debt is just it's snowballing. So, and this is what Musk sees when he comes in and says, "Hey, we need to be cut hardcore." And out of his own mouth, he says, "There's going to be turmoil. There's going to be pain, and we got to go through this to get where we want to go, where we need to go." So, if that's
Dude wants to go to Mars, baby.
he wants to be he wants us to be a multiplanetary species, and whatever. But if I just look at it saying, okay, now if he's going to come in and he's going to say we're going to have to cut in order to bring our debt in place, well, that means these things that we were hearing about, like $25,000, for down payment assistance to who new home buyers and all these things that we were hearing from the outgoing administration, we can't pay for those things. It just adds to the debt, and so I
And it just repeats the cycle all over again.
it does, right? We just keep on kicking the can down the road to the next generation, and in the future, and at some point, the piper needs to, be paid. So, if I take him at his word, and he comes in and does his Department of Government Efficiency thing, I think we're going to see a lot of these delay tactics that were happening in the financial market, saying, "No, we're just not going to do that anymore," right? So,
Yeah, we're just all done.
well, yeah, we can't just keep kicking the can down the road, and we can't keep people that haven't paid their mortgage in their house since 2008. It's just it's a little bit of insane. So yeah,
Well, because they kind of you just kind of got to kick them out. You can be like, hey,
you do,
you're done.
right?
The jig's up.
Well,
We're gonna move on now.
and maybe the not so nice side of me, but then again, I'm the kind of guy that buys delinquent debt and forecloses on people, so maybe I'm just not a nice guy. But it's kind of like, well, you agreed to these terms, and now you're not paying. Could that house be owned by somebody that's a little bit more deserving?
I agree with you 100%. And I do have the soft spot in my heart because I did a ton of short sales
Yep.
from
Well,
2006 to 2011. So I mean, I did, yeah.
and in the discussion I had with somebody last night, we expect to see a lot short sales coming back into fashion.
Oh yay! Here
Yeah,
it comes,
yeah,
ladies and gentlemen.
yeah.
That should be fun.
But just to be clear, I mean, I'm not who's Scrooge's boss. I can't remember. I'm not that guy. I'm only buying these
Isn't that
delinquent
Bob Cratchit or something
Cratchit.
like that?
I'm not a Bob Cratchit, and I'm only buying delinquent loans because I want to foreclose on people. By the time I get these loans, they're already in foreclosure. So if I can work with somebody, and let's say they're less than 36 months delinquent, and they're responsive, they want to be cooperative. I'll try and help them reinstate their loan to get it back to performing if I can, if they want to go on a repayment plan, right? So let's suppose they're 18 months behind. I'm communicating to them through a licensed loan servicer. I have no direct communication with them at all.
Okay.
All right, so the loan is always going to be with a licensed loan servicer. That is, I would say, a very important thing for people to know if they want to get into distressed debt. But I do it through a licensed loan servicer. We communicate with the owner occupant in order to put a loan I'm not modifying the loan. I don't want to modify the loan. I want to reinstate the loan. So
What's the difference? Why not modify?
because that stops the foreclosure, right? That the foreclosure is dead once you
Oh, you want to
modify
keep
the
your
loan.
to a certain extent. And this is going to sound a little raw, but you want to keep your foot on their neck,
Very much
so
so.
that they actually get some shit handled.
Well, they've already demonstrated once that they went delinquent once. I'm not, benefit of a doubt, we're going to try and get you into a reinstatement program, and after a year of making on time. Let me go back. So let's again, they're 18 months behind. Communicate with them. We want to do a loan reinstatement, try to get you back on track, keep you in your home. I need you to bring 4 months of your P&I payments to the table. Why do I do that? I want the borrower to demonstrate that they're serious and committed to reinstating
Yeah, I
their
want to
loan
know
and
that you
get it
got
back
some
on track.
skin in the game.
Exactly, skin in the game. If they do that, after 1 year of on-time payments that can be demonstrated through a licensed loan servicer, a neutral third party that's simply managing the loan for me, they have gone from a non-performing loan and they're now what's called an RPL, or a reperforming loan. And then I can just resell the loan to another investor and just arbitrage the difference between what I bought it at and what I can sell it at, or I can hold the loan for the remaining number of payments that they have for yield. There's a lot of things I can do with that loan once it's reperforming, but I will say that when I do want to work with an owner occupant to keep them in their home, and just help them get back on track.
Now, is there any statistics that you have on the basis of that, where it's like, oh yeah, I would say probably the better part of like 2% actually do become reperforming
Yeah, yeah.
loans or whatever. Do you have any stats at all or no?
There are, but
Or if anything, just a general like a spitball.
yeah, yeah. and again, it depends. You know, I might get a spreadsheet of 200 and some odd loans. It depends on what kind of loans I'm looking at. If I'm looking at things that are seriously delinquent, and I'm buying them, let's say they're 5 years delinquent. Well, I'm going to go to foreclosure on that. It's too late. I can't. They're too far behind at that point to get a reperforming. But again, let's say they're less than 36 months. But in general, we say that, you know, across the tape, about 50% can become reperforming. 25% will have to end up doing something like cash for keys or deed in lieu, or everybody, you know, the real estate investor's favorite thing right now is subject to, because the thing that surprises most real estate investors when they think of properties, you know, acquiring properties subject to, they say, yeah, but due on sale and this, that, and the other thing. And I remind them, I say, I own the loan. I can do whatever I want with that loan. I could forgive the loan if I wanted to. So if you as a real estate investor wanted to come in and say, take that loan over, fine, assume it. It's no longer an FHA loan. It's no longer a this loan or that loan. It's Terravest Capital Partners loan.
Oh, because the classification changed
I
because you bought it.
I own it, right? So yes, there's still a due on sale clause contractually in there, but I can say I don't care who's making the payment.
You don't
Just
give a
make
shit
the
just as long as you're
payment.
getting the damn money.
Right. You know, get the insurance set up, get everything set up the way it needs to be. But if you want to assume the loan and take it over, make the payments. That's fine. So if the repayment plan does not work for the borrower, we can do deed in lieu, cash for keys, or loan assumption. That keeps the foreclosure off their record, right? That still keeps them, it helps them avoid the foreclosure.
But hasn't it already though?
No, when a foreclosure hasn't been completed, no. They're in
Oh, you mean
foreclosure.
completed like as if redemption period's up and blah blah blah. That's what you mean,
Correct.
or
It's not an
sorry about that.
That's right. It hasn't officially foreclosed. They're in foreclosure, but just like as if they had redeemed it or something like that. So,
Oh, okay.
at the end of the day, whether it's loan reinstatement or getting, you know, leaving the property through deed in lieu, cash for keys, or loan assumption, they still avoid the foreclosure. It's only if I take it all the way to foreclosure and take it all the way to auction does it now sit on their, you know, record for the next 7 years and what have you. But that's the last resort.
And as of those of you that are still with us, there is light at the end of the tunnel, as it relates to our economy. And I think one of the major things that are major access points, and that's why I thought it was so important to be able to have Dale on the broadcast this morning. Is one of the guys directly is just to let you know out there, those of you that feel like that you got nobody out there that's an advocate or anything like that. This is one of those companies that's calling. Dale is behind, the company that's calling you and saying, "Hey, how can we fix this? How can we fix this scenario together and actually work together as a team to
Definitely.
get your mortgage made back up?" And same thing with you businesses out there that own these large buildings. They're looking to they want to work things out with you, and there are some creative ways for you to be able to get yourself back on track or get clear out the bats, so to speak.
Yeah.
And so those of you dealing with non-performing debt, meaning like your buildings, you just don't have enough cash flow coming in, maybe because something catastrophic happened with the building or whatever. Make sure you reach out. It occurs to me, you reach out to the bank, and if they're not going to talk to you, you reach out to the person that's actually behind the money. Because in many cases, just because they're a bank, it doesn't mean they have any money. They've got people backing them that are giving them the money to be able to give you the money. And maybe it's a matter of going directly to the source versus just calling the teller, because
Right.
that's never really a great scenario because that's so above their pay grade. And Dale's a type of guy that can do that kind of stuff. Is there anything that we can do for you, Dale, as we wrap up the broadcast here? Is there anything that we can do for you? Anything I can do for you that would bring more benefit to you? Because you brought so much of it, quite frankly, to me today, and really got my juices flowing in my brain as trying to come up with some creative ideas to bring more money in for the company, for my family, and just and be able to bring value to the community that we impact on a weekly basis.
Yeah, so I appreciate you saying that. And let me point first before I get to that. I appreciate what you just said because it's a very key again, depending on any of your listeners, and if one of your listeners happens to be in a situation where they are delinquent, maybe something happened during COVID or whatever, but they are delinquent currently and they are behind, it's essential that you communicate with your lender. The worst thing that you can do in your situation is go dark on your lender. Because again, they can't help you if you don't communicate with them. And I get it. And in the spirit of transparency, I went through foreclosure during the great financial crisis. I've been there. I know what it's like to get the letters and the phone calls and things like that. And it's not a good feeling.
We're gonna slash your tires. We're taking your firstborn.
Right.
Oh my gosh.
Right. And it's kind of like it's an insurmountable thing that you just can't deal with, and it becomes too much to deal with, and that people just shut down. Don't do that. Communicate with the borrower.
Even if you're flooded, just call them. And if anything, tell them, hey,
Right.
I am completely overwhelmed. I don't know what to do here, and I don't want to. I don't want to lose my house.
Yeah, yeah. And even there, I mean, that's what we're looking at too, right? So going forward. With the new administration, we could see changes at the CFPB and some of the things that are required for. Anyway, I don't want to go down that rabbit hole, but we could see changes there too. But yeah, communicate with your borrower, or I mean your lender, and because if I buy the debt, that's one of the things I'm going to evaluate it based on when I look at the servicing history of this particular loan. Has the borrower been communicative? Have they been? Can you reach them? Can you talk to them?
You heard it here. You heard it here first, y'all.
Yeah, yeah. I mean, that's an essential thing, and I can't help you if you don't answer the phone or if you don't respond to, letters or what have you.
Which a lot of people don't.
They don't. They shut down, and I can't blame them for it. But that's not the strategy to take. That's not gonna stop the foreclosure, right?
Head in the sand
No.
very rarely allows you a glass of water to drink.
Yeah, exactly. So where could people help me? Here's the community I'm trying to reach out to through my videos. I'm primarily on LinkedIn, but the community and the people I'm trying to connect to are people that either have a rollover IRA that are sitting in cash, or they have a self-directed IRA. That's going to be a smaller group of people, but let's suppose they have a rollover IRA and it's just sitting there in cash. They're not doing anything with it. And spreading the message to them and let people know is, yes, you can invest in real estate out of a self-directed IRA.
Oh.
You need to be with the IRA custodian that is real estate friendly and knows the process, because I talk to a lot of people that have IRAs, and I said, you can invest in real estate out of an IRA. You can invest in real estate. You can do private lending out of an IRA, or you can invest in what I'm investing in, and that's distressed mortgage notes, out of a self-directed IRA. But I hear him, they said, no, I talked to my IRA people, say, no, you can't. I said, yes, you can. You just have an IRA custodian that doesn't know how to do it. You need to be with a self-directed IRA custodian that is real estate friendly. I'll follow up with you and give you some resources of people to talk to, or of IRA custodians that you could point people towards. There's one in Phoenix I know of. I see them at the conferences I go to. But there's an opportunity for people that want to be in real estate investing, but maybe they decide, I just don't have time to learn how to be a wholesaler. I don't have the skills to do fix and flip. I don't know how to do all these things, but I want real estate exposure in my investments. Well,
just another way to skin a cat.
You can be a passive investor through your self-directed IRA.
Yep, and you can let somebody else do the dirty work.
Yep. So if
you're not going to make as much, but you're
not going to make as much, but it's passive, right? I mean, you're not doing anything. You're simply moving cash that you're not doing anything with out of a self-directed IRA.
But that's what all the big dog investors do anyways.
That's what it's all about, my friend. That's what it's all about. So if they want to work with me at Terravest Capital Partners as a self-directed IRA, and we joint venture on some of this non-performing debt, it's typically a 24 to 36 month hold, and I'll pay them, 8%, 10% yield quarterly, and that just goes right into their self-directed IRA, tax deferred.
Just keep dumping it in there, kids.
Just keep dumping it in there, yeah. And it's completely passive because your custodian actually does all the paperwork and everything in order to make the deal happen. So
yeah, you just keep going to work and doing your union job or whatever you got going on, and heading towards retirement, and you just keep doubling that sucker.
Yeah.
Just keep piling the cash on there so that you can go to Thailand and Mexico and relax.
You should always have your money working for you. If
Always.
you're just sitting there in cash and it's not in a money market or something like that. I mean, what is a money market yielding now? Now that rates have started dropping, you're probably below 4%
Yeah.
annualized yield on it, and that's not even keeping up with inflation. And we'll see what happens with tariffs and everything like that. What happens to the inflation narrative?
That should be interesting. That's
Well,
for
yeah,
another show, ladies and
yeah.
gents.
So yeah, I would say, reach out however you're going to be able to reach out to me. You can contact me, Dale at terravest.fund, Fund. I'll provide you this information.
Dale
Yeah, Dale,
at
Terra, Terravest, terravest.fund.
fund.
And all I'm really trying to do is connect with people that might have a self-directed IRA, or they have a rollover IRA from a previous employer and they don't know how to move it from a rollover from that current IRA over to a self-directed IRA. There is a process there, and the custodians can help you with that.
And that's one thing that the people that Dale can point you to, that one, if
Absolutely.
anything, just give you some verbal or some intellectual confidence
Absolutely.
when you're talking to the people about the stuff that you have no idea about.
Yeah, yeah.
That's all the time we got for today, guys. Holy cow, man. We covered a lot of stuff, and a lot of ground's been covered. So really, really appreciate special guest and local celebrity, Dale Brosey, checking out and enjoying or not, checking out our White Bear Lake studios here in lovely Ramsey County, Minnesota. And just want to say thank you guys very much for taking your time, because I know your time is yours and yours alone. We love you. We'll be here just like we are every week at right around 7 a.m. We'll get it on time eventually. But remember, I'm your favorite Get It Done Dad realtor. And realtors, we're always late. We will eventually get this sucker on lockdown and actually be right on the spot and right on the dot at 7 a.m. However, we're doing our best, and we love you very much. You guys out there, stay classy.